This is One Point Podcast, and I'm Rohit Yadav. India is making its mark in the venture capital industry. It maintains the status of the second largest destination for VC and growth funding in Asia Pacific. When several of its peer countries were witnessing a fall in either VC deals volume or value, India registered improvement in both the areas recently. India has also attracted growing institutional investor interest for venture capital investments over the past 3 to 5 years at a scale it has never seen before. Such a performance is resultant of a lot of exciting trends. At the background, there's strong fundamental tailwinds, capital market performance, digitalization initiatives, industrial and infrastructure build out, and much more. On the venture ecosystem is also expanding and maturing while paving a way forward for itself. And within the venture ecosystem, India's growth stage investing landscape is increasingly getting attention. And to discuss all this on today's episode of One Point Podcast, we have a perfect guest, Ashish Kumar. Ashish, it's a pleasure to have you on the podcast.
Thank you, Rohit. Thank you so much.
Before we start exploring this topic, let me introduce Ashish to you all. Ashish is an entrepreneur turned venture investor based out of India. He has over 2 decades of experience building and investing in companies and believes India will produce many globally relevant companies in various industries. Ashish has founded multiple companies. That includes a global software technology company, a travel technology company, and an early growth stage venture capital firm. He likes to invest in startups at the inflection point of growth and counts unicorns in his portfolio that he also sits on the boards of. He's currently a co founder and general partner at Fundamentum. Ashish, thanks for joining in. I hand it over to you for a brief introduction on Fundamentum.
Thank you, Rohit, so much. It is very exciting to be here. And like you said, India is in absolutely a great position to be in. I'm privileged. I feel very happy that I was born in India. I don't think I would have said this maybe 10 years back that I was very happy being born in India. But, I can say that with a lot of pride that I'm born in India. Fundamentum, we are a early growth stage investment firm, right? We started around 7 years back, Rohit, and the idea there was that while India had seen a lot of early stage investment firms which were investing in early stage companies, and we thought that now we were at a critical mass that it makes sense for us to kind of start a firm specifically focusing on early growth stage investment, and that's what Fundamentum is. So we are currently deploying from the our second fund, which is close to $250 million, and we typically invest around $10 to $25 million in a company once we feel that they have gotten the product market fit right.
Thanks, Ashish, for the introduction of Fundamentum. So, what I will do is I will divide this podcast into three buckets. First, we can cover the high level strategic aspects. Then we can dive into the VC funds, the general partner side, the LP side of the equation. And in the end, we dig deeper into the startup side of the fundraising and how it's growing in the growth stage ecosystem. So let me start with the first question and set the basis of the entire podcast. What makes the growth stage venture capital investments attractive in the Indian context?
I would say two reasons. One is that the talent, right? So the Indian talent is very hungry from creating companies which are multi-billion dollars. So this is a very new change that we have started to witness in India from last maybe 5 to 7 years back. 10 years back, if you had asked people would say that, hey, I'm very happy creating a $1 billion company, exiting, and then basically doing something else in my life. Now when you look at entrepreneurs, they are basically saying that, hey, why stop at a billion, why stop at 10 billion, why stop at 20 billion, right? Why can't we kind of continue to build this business and create $100 billion of companies? And the fact that capital markets are allowing that, so I think that's one big change that has happened, where India is like very attractive, that you could come in a company which has gotten their product market fit right, and they could become very very large over a period of time. The second reason why growth stage investing makes a lot of sense for from an investor perspective is that it's very underpenetrated at this point of time. Traditionally, what had happened is that when India started, we saw a lot of early stage funds, and we also saw late stage funds which were pretty much the international funds who would come into fly in and fly out of India every 3 months, 6 months or so, right? But there was dearth of funds in the early growth stage, which is the opportunity that we saw. And I think there is still void there, even though there are probably few players, but I think ecosystem can take, maybe consume a lot more number of people starting up and doing something in this space.
So, from an Indian perspective, you mentioned 2 points. One is the growth of talent and availability of talent, and another one is the capital market performance. Do you think there are some other factors which is pushing forward the Indian story on a strategic level?
In general, India is in a very sweet spot at this point of time. So besides the two reasons that I talked about, India has a very special place geopolitically at this point of time. So what has started to happen is that if you look at maybe until 5 years back or so, we were good in software, we were good in consumer segment. Those are the two sectors that we were looking at. But now with the geopolitical situation, there are a lot of manufacturing led activity that has also started to happen, and a lot of that is happening because of the this entire China plus one angle, right? So
Yeah.
people said that if I were to take supply chain away from China, which are the countries that I could go to? And given the sheer size of China, even if a small percentage spillover from China to any of the country, including India, could be fairly large. And India is a big, big beneficiary. So that's another reason, another activity that I'm starting to witness in India.
Understood. And if you look on the LP side of the equation, which are the LPs who are most interested in the Indian growth stories? Is it the sovereign wealth funds? Is it the corporates? Is it the private equity kind of funds, hybrid funds, which also invest in private equity as well as venture capital? Or is it plain VC focused funds? Is it something else? So which are the LPs which are mostly focused on the Indian story of growth stage right now?
Yeah, good thing is the answer is all, right? I think we have a very able prime minister who has done a great job at putting India on the map. And I think he has done a great job at educating people on the opportunities that India provide. And when I speak with LPs, I think there is excitement to participate in multiple segments that I wouldn't have imagined, let's say, a few years back. Now, the kind of asset these LPs would be interested in will be slightly different. That's a nuance. So, as an example, sovereign funds are happy or more eager to invest in significant long term assets, which could also not only give them, let's say, investment returns, but they could also give, let's say, some sort of dividend returns over a period of time as well, right? That's
Yeah.
where the sovereign funds come into play. Then there are corporates who are also looking at both financial and strategic returns. So they like to invest in places where there could be some strategic value as well, because they also want to learn from what the innovation that is kind of happening in the country. Similarly, there will be, let's say, foundations and endowment funds who are a lot more financial investor, and they say that how is that I can participate in the companies which could give me returns over a 7 8 year time period, and then I effectively rotate that money or roll that money into multiple funds, right? So that's how India has been behaving at this point of time.
And if we consider the LP set that you just described and compare that from a domestic versus foreign LP base. So if you have to gauge the interest from these two buckets, how will you rate it? And which are the LPs in the domestic market who are more excited? And which are the LPs in the foreign countries who are best suited to invest in the Indian ecosystem?
Great point, Rohit. India private equity market and the venture capital market actually did not see domestic LPs for a long period of time. It is only in the
Mhm.
last 5 years that that number has increased significantly. If you look at data of all the money that comes into venture capital funds in India last 5 years, until last 5 years, that the domestic LP participation would be in single digit, maybe 4%, 5% or so. That number right now of all the new capital is almost close to 25 to 30%. So that has
Wow.
gone through a massive, and I think that this number will further go up. There are two reasons for it. One is that India has actually seen wealth being created by families and by institutions over the last 5 to 7 years, right? There is significant amount of monetization that has happened, and people are trying to figure out which are the assets that I could kind of come in and invest into it. The second is that some of the companies which were started in the private world, the likes of Zomato and the Paytms and many more Policy Bazaar and many more such companies. They have gone listed, created value in a span of, let's say, 10-15 years, that most companies in India took probably 50 years, 70 years, 80 years. So in general, the LPs and the investors have seen that, hey, this is a great way to kind of create number one value and effectively be also part of the nation building, right? Because ultimately, anytime all of these companies come into play, it also helps in creating the nation as well. So there is, while there is a financial return, there is also this factor of I have contributed to the kind of entire nation building. So that's what is kind of creating the domestic LPs. Domestic LPs are of usually two types, both strategic and financial. So large part of this right now is financial, less of strategic at this point of time. But I would think that this ratio would start changing. I think financial will continue to be large, and that I believe is the right way to do it. But we are starting to see, let's say, entrepreneurs or founders selling their companies for few hundred and billions of dollars, and they are coming and say that, hey, you know what, I understand this industry, I actually want to invest in this industry because I could also add value in the business other than purely just enjoying the financial returns. So that's how the domestic LPs have
Got
been
it.
performing. International LPs have usually been a lot more sophisticated because they, of course, have been investing in this asset class for a long period of time. And larger part of the international investors that we see in India are mostly the North American,
Yeah.
and I would say some Asian. European LPs are still small, far and few in between, and I think as a country we have to do a better job at exciting European investors as well.
Okay. And what makes you think that the European LPs are missing when they are evaluating the Indian growth stage investing
I
ecosystem?
think in general, from a business fraternity perspective, India and the US is lot more better understood because
Mhm.
uniformity of language, and so on and so forth. In Europe, of course, there's just multiple countries, all different languages. I think so. In general, the familiarity between India and Europe has been on the lower side. So that's
Okay.
basically one that reason that I've understood. Second is that I also see that Europeans also need little more time and comfort before they could build decisions around whether they can invest in India or they want to invest in India or not, right? And typically, my conversation with our European LPs and US LPs are very different, right? My conversations with European LPs are more about, let's say, regulation, policy in India. So they are thinking about those macros, right? Whereas when I speak with, let's say, my American LPs, they will talk about asset, company, industry, and so on and so forth, right? So it's a very natural evolution that you first build comfort around a country before you start talking about assets. So American investors have built that comfort. I think European investors will have to continue to build that investors, and I think this is where both politicians and the people like us, right, who run funds and companies, we will have to do a better job at educating that. And lastly, Rohit, I think nothing sells better than results, right? So if the country is
True.
able to demonstrate good results, create large value, I think a lot of these questions also start becoming less and less important, and people look at opportunity more than just the risk.
Glad you captured these nuances, Ashish. It's really relevant for everyone to understand these nuances. Moving from the LP side to the GP world, to the fund managers, you touched upon this point that the whole ecosystem of growth stage investing has evolved very recently. Can you track this journey for the last 5 to 10 years and just tell the audience of how it has evolved? How many funds were there initially? Maybe how many funds are there right now? Are these funds more focused on one single area? Are they generalistic? What's the typical size of those funds and so on?
No, I think absolutely great questions. If I go back in time, right, so Indian startup ecosystem truly started developing maybe around 14, 15 years back, Rohit. And this is like around 2009-10 time frame. And this is when multiple early stage companies and funds have came into play. Very logical. There was no ecosystem, so naturally people will be early, companies will be early, and as a result, funds will be early, right? And we saw some result over the next 6, 7, 8 years. The growth stage ecosystem truly started developing maybe around 2016, 15, 16, 17 timeframes. Our first fund was around 2017, so we were really one of the first ones to be doing it, or pretty much the first one to be doing it. uh, and what had happened by then is that people have seen that as a country we knew how to iterate to get to a product market fit in a company, but as a country the scaling up template was still in the making. It was very early, and you had to be you had to be genius to be able to scale, and not really average person to be able to scale, right? Whereas I would say that the bar was, since the familiarity in early stage was so much that there was almost a lot of template made to get to the product market fit, right? So from a timeline perspective, I would say 2016-17 is when the growth stage funds started to come in. When we came in, there were like two funds, in 2017, who were really specializing in the growth stage, right? And there were early stage funds who also were doing growth stage, but
Okay.
their ability to invest in newer assets which were not conflicting with one of their investments was a challenge, and as a result the space required neutral capital, neutral growth stage capital. So there are two funds then. The peak really happened in around 2021 timeframe, which is when, of course, the entire world thought that technology was the place to kind of park money in, and so on and so forth. We also saw. So at that point of time, if you look at all types of growth stage investors, probably there were 20 odd in the country, right? And I will say maybe five of them were all homegrown, and 15 of them were probably the overseas investors who were investing outside India, but they saw opportunity, they flew in, and they said that, can I also do growth stage? The
Okay.
good and the bad part of that is that the moment that economy and that exuberance receded, right, a lot of those 15 have actually gone back, and maybe a two or three of them remained in India, and they're doing structurally. But the good part is that the five or six which were more homegrown, right, or who have full teams, even if they were, let's say, overseas funds, if they created a full blown team in India, they are now deploying. So right now the market, I still think it is very underpenetrated, right? And the number of funds which are truly looking at this space is maybe, still a single digit number, maybe seven or eight funds who are structurally looking at it. I'll also give another data that could be fairly interesting. Let's say if the $100 that goes into the Indian ecosystem,
Hmm.
around 40% goes into early stage, the last 40% goes into late stage, and that only 20% goes in the growth stage at this point of time. And this is the number
Oh,
today. 5 years later, 5 years back, this number was only 5%, right? So while this number has come up significantly, the right ratio should be 33, 33, 33. That's where we have to get to. So we still have some distance to cover.
okay. That's a very interesting topic that you touched on. So you see a clear gap with respect to capital that is required for the growth stage ecosystem. And can you correlate to the LP side that are LPs excited about this area, and do you foresee in the next 2 to 3 years that there might be, let's say, new funds from your side, or maybe new funds popping up in India?
Absolutely. So if you speak with global LPs particularly, or in general, actually any LPs for that matter, earlier for them, the category that they would invest in was Indian venture capital firms.
Mhm.
Now they are basically saying that there are two categories: Indian early stage venture capital firms and Indian growth stage venture capital firms. So that has basically happened in India, that people are clearly making allocations. So India not does not have only one allocation in venture capital. India has actually two allocations. Not all LPs are there at this point of time, but I would say significant number of more progressive LPs have actually moved there, and I think they understand that the risk reward in India in growth stage, surprisingly is actually superior than very early stage. And just primarily because the number of funds who are uh, existent in the growth stage at this point of time, and it is so little that you can choose the best investment and the best companies without really giving into the FOMO or the fear of missing out, that if I don't act fast enough I would probably miss out, right? So I
Yeah.
think that is where the industry is.
Okay. And with respect to the size of funds of the growth stage and the thesis, do you have any
Yeah,
points on
so
that?
there are funds starting from a growth stage, depending on the how much technology and how much of mixed bag that they are investing in. The sizes are anywhere between $200 million to almost $1 billion. I
Okay.
would say the median will be maybe around 250 to $300 million. If particularly if they're investing more in technology firms, 250 to $300 million is the median size of the growth stage venture capital firms at this point of time.
Okay. And most of those five funds or 15 that were there from outside, are they thesis driven? Like they're focused on certain consumer sectors or fintech sector, which has been traditionally very popular in India, or are they journalistic ones?
So at growth stage, at a broad level, most will be, so everyone will be thesis driven, but horizontal, which means
Okay.
that they would invest into not one area, they would invest in multiple areas. So India, the depth of the market is that you will have to choose either domain or you have to choose stage. You can choose both. Maybe
Okay.
10 years later you will have to choose both, but right now you can't choose, right? So if you're an early stage firm, then you will have to choose industry. But if you're a growth stage firm, you will basically say that, hey, this is what I've chosen. Of course, you will build biases based on, as let's say, general partners, what is that you understand better. So as an example,
True.
we as people understand software, we as people understand consumer lot better than, let's say, manufacturing, as an example.
Right.
So which is what, those are the two areas that we would focus on.
Got
but,
it.
but at the same time, there are other, let's say, venture capital firms which are focused more on financial services. While we will also do some financial services, but we are not a predominantly financial services. But whereas some firms will do financial services only. Some firms will probably say that I will only do, like software as a service. I would not do consumer. Some firms would only do consumer. So that distinction is starting to happen. But I think this is where specialization will happen more and more over the next 5 to 7 years.
So it's a kind of a maturity which will the ecosystem will gain on in the coming years. For sure, yes.
Absolutely.
The last question on the GP, LP, and the venture fund side. What are the biggest challenges that you see for VC fund managers at the growth stage?
Um, the biggest challenge would be to balance growth and profitability for the companies and effectively guide them on what is the right way to balance these two, right? So, see, companies that we invest in are only valuable when they are growing,
Hmm.
right? Now, if they are growing with their unit economics diverging, there are no takers for it, and rightly so, right? So, how do you balance while maintaining and increasing market share is a key question. It is not straightforward. It is difficult because we are a very competitive country. For every company that
Yeah.
you would start, there will be at least five other people who would also start that company. They would also raise capital, and the moment, and you're also going after the similar set of customers, so naturally the customer acquisition cost increases and so on and so forth. How do you manage that mix is an important question, and it is a question both for the founders and the investors. So as an example, if you look at one mistake that investors have done 5 years back was to invest in too many companies doing the same thing. Now people have become more mature and people are saying that, what, this space can only have take so many players. So, I would not invest more than, let's say, seven companies in a space, and then I will
Mhm.
look for which is the company that is actually doing well, and then maybe give them the companies which are doing better, more and more capital, rather than basically seeding another eighth one. So those are some of
Got it.
the learning that people have had.
Got it. So the challenge that you just described is more from a portfolio perspective, how to grow the portfolio companies, startups, acquisition side. On the other hand side of the equation, so the capital coming in, do you see any challenge for the VC fund managers over there on on the capital on the LP side and so on?
Not really. I think in general, India is in a place where there is demand is larger than supply, right? So I think
True.
the challenge is to accept capital which is net positive rather than may not necessarily be the right fit, right? So how do you know that, given that many of the fund managers are also, new? If you think about, they're probably raising their second fund, third fund, first fund, and so on and so forth. They may not have that maturity to be able to understand that, and that's a challenge that I think as a nation we have to solve. Even as an LP, if they're looking at it, they should probably look at the GP. While they could put money in, let's say, five funds, they should choose where they think that there's greater meeting of mind, greater meeting of what they want to do from their capital, in terms of the non-price value, right? Not only in terms of the return, financial returns, but some kind of impact. So if they could do that matchmaking in a nice way, I think it will be net positive for the entire ecosystem.
Makes sense. I think India has captured the imagination of a lot of LPs. So capital is there for India. It's more about, as you mentioned, the matchmaking, finding the right kind of LPs who will stick in the long game with the GPs and so on. Makes total sense.
Absolutely.
Let's switch gears and focus on the startup in the growth stage investing. And the first question is on the fundraising side and how the ecosystem for the startups have evolved. What are the biggest changes that you have seen from 2022 to 2023 and from 23 to the first half of 2024? And as a background, we all know Indian ecosystem was also impacted like the global one. So there was a peak around 2021 time and 2022, and we saw kind of, deal flow and volume kind of going down. So please help the audience understand how the growth stage startups fared in the 2.5 years time span.
I think again, good question. So 2022 was difficult to impossible for everyone, Rohit. I think it was just the time that people were coming off the peak, and people just worried, anxious that hey, what is going to happen, right? And so it was just difficult for from the startup perspective, irrespective of whether they were good companies or not so good companies. 2023 was the time when good companies, there was differentiation that came in people's mind between good companies and not so good companies, right? So good companies actually started becoming lot it became lot more easier for them than it was in 2022, because people could see that it is not one bucket, but it is there are two different
Okay.
buckets, right? And I would say 2024 that bucket has expanded, right? So because what has also happened, that companies who were in the second bucket, which were not so good companies, they also went back to the drawing room, understood and accepted the fact that they were not very good, and realized and worked on it, and they've effectively moved themselves to a bucket one. So if you look at 2023, maybe 5% companies were, or 10% companies were in bucket one. I think in 2024 maybe 25% companies have moved into bucket one. So it has become increasingly
Wow.
easier. It feels easier, which is why you see a lot more venture activity happening, a lot more deals being announced. But I think this was great time for Indian ecosystem to mature from a startup perspective as well. And that you should not only start companies because money is easy, but you should start companies when you actually want to create value over a long period of time.
And that is definitely true. And so what you're saying is you kind of saw the bottom of fundraising cycle in 2023, and now in 2024, have you seen a growth in the deal size, in the volume of the deals that you're seeing right now at the growth stage? Tell us a bit more about
Vo-
this.
Volume of the deals actually have gone up, not necessarily the check sizes. Check sizes have actually become smaller,
Okay.
and than let's say 2021, right? It's primarily because of two reasons. One is that people are saying that the competition is lesser. So earlier, since the competition for the same customer from multiple companies was high, so people naturally needed more money because they were burning through the money to get to the same customer, and the customer was like significantly pampered. That competition has reduced, so that automatically means that you need less capital. Plus there is this learning that while the companies require capital, they should learn to deal with scarcity as well. So don't give them too much of money that their DNA changes, right? So I think that, and that's a basic premise of all startup, right? You have to achieve more with comparatively lower resources. And that is how best companies are created. So I think that is what is happening in India.
Fair point. And I think this trend is being seen across the world to some degree.
Yeah.
With respect to deal dynamics, single deal dynamics, what's the typical check size that happens at the growth stage? And what are the deals that you're seeing right now? Are they up rounds or down rounds or flat rounds? How would you paint a picture on this topic?
So the deal size in a typical growth round, early growth round, will be anywhere between 20 million to 35 million, right? These numbers were maybe 30%, 40% larger, in the during the peak time, or maybe even more. but $20 million to $35 million, depending on whether you are, let's say, a B2B company or a B2C company, right? Or a B2C company usually will require a little more capital, so they will be on the higher side. A B2B company could be on the lower side, right? So that's the check size that people are looking at. What was the second question, Rohit?
Up rounds versus down rounds or flat rounds?
Right. I will say moderately up round is the bulk of what is happening, because people are saying that if the company is not so good, I would rather not invest rather than doing a down round, right? And if the company is interesting, because not too much money has gone in into the last 2 years, the company have also grown. So from their last round valuations, even though the multiples have shrunk, but
Okay.
the valuation is still high. So I'll say moderately up round is the more trending thing at this point of time. Down rounds are there, but that usually happens for companies who are stuck, who are fundamentally good companies, but they probably made some bad decisions during the 2021 timeframe. So as an example, there have been companies who took large amount of debt to kind of, let's say, finance certain purchases, acquisitions, or growth, and so on and so forth, right? And now with the interest rates going up, they have to kind of pay that back, and they have kind of stuck a little bit, right? So, and since the companies are good, they are still getting money, but then there are more down rounds happening than really kind of up rounds happening.
Okay. So what I hear is GPs and fund manager are being bit risk off, like they are right now globally as well. So they are just focusing on deals which makes real sense, and not just on paper, but also in reality with respect to different KPIs and so on.
So I'll argue that I think they were always like that, right? I
Okay.
think the way people associated meanings may have changed. So as an example,
Mhm.
I would say, see, so venture is a game of investing in future outcomes, not all of which that you will be able to predictably see, right? Because
True.
that's where that alpha is created. Otherwise, you could just be a private equity investor, and and which is also a great business to be in, but that's not what venture capitalists would do, right?
True.
But the ratios are different, right? So now, earlier, I would probably was happy with taking higher risk on maybe 30% of the portfolio, right, or a 50% portfolio. Right now, I will take a higher risk on maybe 10% of the portfolio, 20% of the portfolio, right? So those ratios have changed a little bit.
Got it. Understood. Understood this nuance. One of the most important questions that come about the Indian ecosystem is the kind of deals that you are seeing with respect to the business area. And largely it has been SaaS opportunity, fintech opportunity. How do you see the growth stage has grown in the last couple of years and even this year? Has the business area now diversified? Do you see more startups coming up for fundraising to your fund, which are not just focused in fintech or, for example, SaaS, but also rather, let's say, deep tech, climate, and so on? And how do you see this going forward in the next 6 months to 1 year?
Absolutely. So besides SaaS and fintech, I think consumer was one large sector that continued to kind of draw a lot of attention, right? And consumer also, there are two types of consumer businesses. One is platform businesses, and the other is, let's say, brand businesses, right? And
Mhm.
both of them were getting. But you're right, at this point of time, it has significantly diversified, and it has happened because of two things. One is that India has decoupled a little bit in terms of the venture ecosystem from rest of the world, because Indian government, because of the geopolitics, right? So as an
Mhm.
example, export is a larger focus than it was, let's say, even in the startup ecosystem, than it was, let's say, 5 years back. And this is not limited only to software. This is now limited to, let's say, some defense items, right? Then manufacturing, whether it is electronic, whether it is textiles, whether it is a few other items as well. A lot of that also has started to become a lot more important, and there is action there, and those are the companies which are getting funded. I will say deep tech is a is absolutely at an inflection point at this point of time in India, because the deep tech startup ecosystem maybe started developing 7 8 years back, and it is a large gestation period for them before they could start making their first revenue. Right, that's the nature of the deep tech industry. So I think
Yeah.
we are at a critical mass. Next 2 years is going to be very very important. But in deep tech, as an example, there are some sectors like space where India has actually taken a leap, right? So, and thanks to ISRO, because we had the talent and infrastructure and so on and so forth. Similarly, in climate, I think we are probably early, other than EVs, where of course there is some distance that we have covered. I think on climate we are slightly early. I my uh, sense is that India will go deeper into two or three areas, lot more than going broader into the deep tech and the climate side, like space being
Okay.
one, EV being another one, some of the alternate energy being the other one, right? So those are probably the three areas that I think, specialty chemicals being another one. So some of those three four areas is what India will probably go a lot more deeper into.
Okay. And do you see the fintech and the consumer picking up in the next 6 months to 1 year again?
It is a more understood technology play now, right? So now only those companies will get funded which will have a predictable path to IPO, let's say 5 years after the growth stage investment that they could do, right? So it's a more understood, more templatized, you hiring of talent is easy because there are like umpteen number of companies who started doing that, and you could effectively get people from many of those companies as well. So it will continue to be a mainstay for Indian technology ecosystem for a long period of time. But the bar is higher in terms of their, when and how they can exit and give returns to the investors.
Perfect segue into my next question. So, if I have to capture the exit environment, and growth stage is not the perfect exit opportunity for the IPO, right? But there is still M&A happening at the growth stage. How do you kind of paint a picture and define the whole landscape around M&A for growth stage companies? Is it really existing? Do exits really happen at this stage, or do you see that India is just, let's say, IPO focused exit opportunity?
If you are investing in a growth stage company, and you
Mhm.
are underwriting at least 5 times, right, which basically means that you are looking at a return company enterprise valuation of at least a $500 million, if not more, right?
Mhm.
Then IPO market is one that you have to plan towards. The number of $1 billion M&A opportunities in India will be very, very limited, at least for the next 5 years. And that's primarily because we have to see a lot more technology companies, which are public, which will ultimately end up buying. It's unlikely that a very large corporate would actually acquire another startup for $1 billion. It does not look like going to happen. So the way that I believe India will basically create this entire opportunity is that next 5 years there will be, if you are investing in the growth stage, you have to account for the fact that which are the companies which could IPO in the next 5 years and at least be $1 billion in kind of outcome. And the good thing is that as long as you plan for it and you plan for your capital efficiency accordingly, profitability accordingly, India is a great place to actually take company public at that number. And
Mhm.
once that starts happening in a 5 years, my sense is that we will probably have maybe 50 companies which will go public from technology startup ecosystem in the next 5 years. And then that is when we will have critical mass for the M&As, for large scale M&As to actually start happening. Right now, M&A will happen, when and the right place will be that you do a seed stage or series A and maybe exit for 100 to $200 million. But that's not what we like to do. We like to come in at that stage and then grow the company to $1 billion value or more.
Makes sense. And from an IPO perspective, India is like a shining star in the IPO world, right? So there are a ton of IPOs happening. I think from the number of IPO perspective, India captures one of the top positions in the world. Even though the IPO size might be smaller compared to the US and so on, but still India is doing really well compared to Europe for sure. Yes. So it's a good chance that India does
Absolutely.
really
And
well in this area.
I was some maybe slightly dated. I was looking at this data. If you look at Indian public markets, number of companies which are in the public market which are valued $1 billion or more
Mhm.
is in the range of 200 odd, 200 to 30, somewhere in that range. So it's a very small number if you think about it right now. And we have 100 unicorns in private world at this point of time. So if some of these companies actually start getting going public, that number will go up. So the point is that there is scarcity value in Indian public markets, and Indian public markets are hungry for more larger companies to be public. And ultimately it is the venture funded companies which will go public now, because those that the kind of talent that is coming into those is significantly higher in a venture funded company vis-a-vis, let's say, a bootstrap company at this point of time, right? So that's
Mhm.
how I see the market evolving.
True. Maybe we can talk about a portfolio companies or yours, or maybe a hypothetical example of a growth stage company which came on your desk as a deal. What are the typical KPIs that you look for while investing in a growth stage firm? Maybe you can elaborate on, let's say, revenue levels, growth, team size, much more data
Yeah,
on this topic.
yeah. So generically speaking, and this will be the answer will be a lot more nuanced depending on what sector and
Yes.
what business model are they in. But effectively, we are saying that a good growth stage company are the ones where the gross margin of the company is anywhere between $10 million to $30 million, right? Which means that the revenue, depending on what is the business model, could be, like, let's say, $50 million or $30 million, or could be $100 million as well, right? So that's the stage that we are kind of talking about, right? And these companies would typically be, let's say, valued maybe $50 million to $200 million in size, right? KPIs that we look at is that besides the revenue, which is a function of the space that the market that they are in, are basically, are they increasing market share vis-a-vis competition or not? Because
Mhm.
technology companies exhibit oligopolistic behavior, right? So there, it is not that there will be 30 companies doing the same thing. There will usually be 4 companies doing the same thing or similar things, and sometimes even more concentrated. So you have to continue to increase your market share. That's number one. Second is that your NPS, or the net promoter score, or the customer satisfaction score, has to be top notch, because for your understanding that your customer value proposition is very deep, the NPS or the customer satisfaction score basically tells any investor that, hey, this is what is kind of, this company is actually doing well. And some of this is as measured by the company, and this is where an investor being on the ground is very, very helpful, because your ability to speak to the end customer is significantly high there, right? So we think that the best investors don't sit in the office. The best investors are actually out in the market, kind of talking to people and understanding it, right? And the
True.
third is the converging unit economics. Again, the unit economics, I'm not saying that it has to be zero, positive, neutral, or whatnot. I'm saying it has to be converging rather than diverging. Because when it is diverging, you question that the value proposition was just a price. And that's not a good position to be in, right? You could use price lever for bridge scale for a short period of time, but fundamentally the unit economics has to be converging. So I mean, if you look at these three, while there are multiple nuances, you'll probably cover maybe 80%, 85% of like KPIs.
Okay. And is there India specific KPI that you look at, for example, which you think is very different from the way growth stage firms are
Business model.
evaluated in Europe or in the US?
Business model, right? So business model is that, as an example, India, basically you will see more successful models being full stack rather
Mhm.
than as a let's say light marketplace. And there's a reason for it. So as an example, I'll give you an example and I'll tell you what, right? So the most successful uh, e-commerce companies are all inventory led, whether it is pharma, whether it is grocery, whether it is product, electronics, and whatnot. In some way, they're inventory led. It could be on their balance sheet, it could be on a partner balance sheet, but logically they're inventory led. And whereas if you look at, let's say, more developed markets, these are all light marketplaces, and they don't hold inventory and so on and so forth. Right? That's how people have created it. And the reason for that is, in India, the unorganized market, the quality and the focus for customer satisfaction is actually not very high traditionally. So you will have to create that layer of supply chain where people are focusing on high customer satisfaction, because you could fix economics over a period of time. It is a lot more harder to fix like customer centricity. So customer centricity, you have to start with that. So that's where
Wow.
India is very different. And I when I speak with a lot of my overseas colleagues, European and the American colleagues, it is not very intuitive to them, and I can understand then why it is.
True. I mean, these are the nuances which you wanted to capture in this podcast. So thanks for putting a focus on these. And so one of the last questions on the startup side, if there's one piece of advice that you would like to give startups at the growth stage, what would it be?
I'll say two things: go all in and ensure that there is founder market fit. So you
Mhm.
should truly love the problem that you're solving, because it is a very long game, right? And you become a shadow of the company, right? Your personality will change over it. If you're doing something for 10-15 years, I think that's what you are thinking all the time. 80-90% of the time you will know those people. Your families will be interacting with, let's say, your colleagues or people in that industry, and so on and so forth, right? So you have to
Mhm.
truly love that problem. Every time I've seen people, great people, not doing well after growth stage, it is basically one of the, I've almost always I see one of the two reasons: they have not gone all in, they're hedging, saying that, hey, I could do this and I could do that, right? And then the moment you hedge, then there's a problem, right? Because you bail out at the first time, the first difficult times, and the companies go through multiple difficult times during that journey, and you have, the moment you're all in, you'll figure it out, right? Over a period you'll struggle, but you'll figure it. And if you
Mhm.
love the problem, then you know that there is nothing else that you can do better, right? If there's nothing else that you can do better, then you will do this, right? Rather than again bailing out.
True. That's true. I mean, founder problem fit is one of the like core KPI that any investor should look at. And it's important for founders also to kind of realize that they are going, as you said, all in and they understand the market, without which, the chances of succeeding are actually truly less. So that's
and
true.
and truly you have to enjoy the journey, right? I think of course we have a lot of wise people have said this, and I'm only kind of copying them. The fun is in the journey, not the destination. And you don't know the destination genuinely. There have been umpteen number of scenarios that people have spent 10 years and they think that they were just about to make it and nothing happened. And on the contrary, there are other examples as well, that people stuck around for 10 years thinking that nothing would happen and something just happened, right? Great happened, right? So you have to truly enjoy the journey, right? Yeah, so you have to be a little more maybe purist in that sense.
Thanks for this nice explanation. And I think this last question was a good kind of closing for this podcast. I'll switch and just ask one personal question, if you allow me. What's the most interesting book, movie, or it could be anything that you have that you would like to share with the audience right now?
Outliers.
Outliers.
Yeah, it has
Okay, why is that?
just changed the way I thought about things, right? So, and I'll give you a personal anecdote. I have kids who are youngest in their class, right? And I thought I was doing a smart thing, that like they would study early, right? And when I read Outlier, I was, and if you've read that book, right, there's one example that the book talks about, is that when you are very young,
Mhm.
right, a difference between the physical capability of a kid who is 5 years old and a 6 years old, right, is 20%. A person who is 40 and 41, there is hardly any difference, but a 5 year and 6 years. So if you're youngest in the class, you get, you're weakest, so you get less opportunities. When you get less opportunities, you get less exposure, you learn less, right? So you have to work significantly harder, whereas when you are eldest, you're physically stronger, so you get more opportunities, and so on and so forth, right? So, and this concept, while this is applicable, let's say, in sports, or but this is also true in many aspects of life. So, when I now look at even entrepreneurs, I try to go back into their childhood. What is that they have done? Because effectively, I'm trying to find two answers. What is their core belief, right? Where are they coming from? And the second question is that what are they bad at? Because because when you are bad at, you compensate by being extra, good in certain areas, right? And in a very competitive world, it is very difficult to be good in everything. you have to be excellent in something, and that comes at a cost that you are probably not so good in everything. And a lot of times it is very difficult to understand that you're exceptional in something. So if you're able to realize that the person has some very clear limitation, it is easier to understand what they may be good at, because it's usually the inverse of it.
True. I have a son as well, so I can, and he's the youngest. As you said, it's just a coincidence, and I can relate to it to some degree. So we are just having this tennis course with him, and I can see the difference between 6 months older kid versus him, and he's picking up really nicely. But let's see. I'll read Outlier's book. Thanks, Ashish. Thanks for joining this podcast and talking to us for 50 plus minutes. Thanks for enlightening all the audience on this very specific one point of growth stage startup investments in the ecosystem of India. Thank you so much.